This is certainly not the first storm to hit Florida, and it's not going to be the last. Anyone writing in Florida comes with the expectation that you're going to have such a storm. It could bring some immediate issues with claims getting paid just on volume.
Hurricane Ian was the deadliest storm to hit Florida since the Labor Day hurricane of 1935.
And it wasn't just deadly, it was expensive too. RMS estimates that Ian was responsible for insured losses of upwards of $67 billion.
I'm John Weber along with Lori Chortis. Make no mistake about it, Hurricane Ian was massive, and that's bound to have an impact on the Florida insurance market.
The flip side is, storms like this could also bring, some significant rate increases and open up opportunities for new insurers to capitalize, or insurers who are already capitalized outside of Florida to maybe enter the state.
Beyond insurance, though, is the matter of resiliency. While Florida got hammered by this destruction, it really could have been worse. A lot worse.
Florida has a really good building code, and they have been leading the way on building codes post Hurricane Andrew. Now, it took a while for the building codes to get into place after Hurricane Andrew, but that was a pivotal moment in the history of codes, both for the state of Florida and nationwide.
Still, a lot of the buildings in Florida that were destroyed by Ian were built prior to 1992. Look at this destruction in Fort Myers. All of these buildings were built prior to Hurricane Andrew in 1992. Now take a look at this. These buildings, which were built within the last 30 years, had no trouble standing up to Ian.
Even when we have good building codes in place, the system is working, a lot of the buildings are older, and so it takes a while. But the good news is those buildings that are built post-Andrew code have apparently done pretty well.
And while these newer building codes are important, there are some who would argue that mitigation has to come from somewhere beyond the government.
I think insurance can be doing more to help reduce losses ahead of time. It could do this by providing financial incentives to reduce risk. We know, right, insurance costs are fundamentally related to risk levels. So the thought is that if you lower the risk, you can lower the cost.
But let's consider a worst case scenario, Lori. What if the state's hurricane fund is depleted?
Or what if Citizens, the insurer of last resort, just exhausts its claims paying ability?
Citizens, anytime you lose, 7% of your coverage, because that's about what their market share is within the state, yes, it's going to create some turmoil. It's going to put an overall capacity crunch, and you would see probably some more rate increases just on capacity alone of the remaining insurers. But it's not just Citizens that could be an issue here. There's several smaller insurers in Florida who might be writing at, say, a 5-to-1 or 6-to-1 premium to surplus ratio. For a storm this size, if they don't have adequate reinsurance, they might face trouble as well.
But with each new hurricane, we do seem to get closer to ironing them out.
Both from an insurance and a resilience perspective.
Along with Lori Chortis, I'm John Weber for AM Best TV.